Welcome to Senior Living Investment with Emily Bow. It's my absolute pleasure to introduce our guest, Matthew Copley, CEO of Copley Financial Group. Matt is a financial advisor with close to 10 advisors working under him who specialize in helping retirees and pre-retirees plan for and navigate their retirement. With over 600 clients and a combined asset base of over $1 billion under management. Matt is passionate about helping people maximize their retirement income and minimize their taxes. Welcome to the show, Matt.
Thank you for having me. It's wonderful to be here.
Thank you. My first question is, can you please share some insights into your company and what inspired you to pursue a career as a financial advisor?
Well, I actually never really thought of myself when I was younger wanting to be a financial advisor. I started reading a lot of books when I was a teenager. When it came to how to make money in the stock market, that was a book I wanted to read, and just investments in general. And the main reason that drove me is I wanted to be rich. I grew up not in the highest income household. I remember going to my friends' houses who had the Nintendos and, their parents bought them new bikes. And I kind of didn't get some of that stuff as a child. And my parents were great, and they just didn't have the funds. My dad worked at a grocery store. My mom worked as a waitress and then later at a drugstore. And so I really wanted to make money and be successful. And I knew the stock market was a great way to do that, and investments in general. So as I learned about all these things when I was in college, I actually went to work for this company. And back then it was called White Securities, and Brian White was the owner. And so I learned that I'm pretty good at financial planning and investments. And so I started helping other people with all the things that I had learned. And so a lot of this actually began before I got into school. I learned a lot of it on my own.
How did you help people before you even get into this?
I've got some great stories. A friend of mine, when I was a teenager, he actually got a settlement and won a bunch of money, hurt himself, hurt his leg or something, and some grocery store paid him a settlement. I think I'm guessing, it was probably around $6,000, something like this. This was in the 90s, so it was a lot of money back then. And he called me, and he knew that I knew about investments and finance. And he asked me, he said, what should I do with the money? And I said, well, I just read about this company. It's based right here in San Diego, new company, and they're involved in the cell phone industry, which I was interested in. And I said, you should put all your money in this company. And it was Qualcomm. And of course, this was a no-name company at the time. And instead of investing in Qualcomm, he bought a new Camaro. And so he had a nice car to drive. He was looked good in that Camaro. But we did the math a few years later. By early 2000, that $6,000 investment would have been worth over $200,000 had he taken my advice. So that kind of was early on as a teenager. And then I just was interested in investments and finance. And so when I went to work for Brian, I was a young guy. I was 24 years old, didn't have any, responsibilities, single guy. And of course, my life's quite a bit different now. I've been married now for 21 years. I have 4 children. So I've been doing this for 24 years. So that'll tell you how old I am. But yeah, that's kind of how it all started.
Okay. And what led you to specialize in retirement planning?
So retirement planning, I think the main thing is when I went to work for Brian, a lot of his client base was already older. He was quite a bit older than I was. And so I started when I was 24, and Brian was already almost 60. I think he was actually over 60 years old at the time when I went to work for him. So a lot of his clients were older already. And when we started working with a lot of these clients, I just saw so many people that made mistakes that I wish you hadn't done this. I wish you had done that. I wish we would have done a Roth conversion, years ago. And so I just thought, I'd really like to get a hold of people before they make all these mistakes and, early on in their retirement or maybe before they retire, and build a plan for retirement. And so when Brian retired and I took over the business in 2014, this is when I really started focusing heavily on retirement planning. And that's when I got my fiduciary license shortly thereafter. And from that point, we really made it a focus to work with people in retirement. And we try to get them in the right position so they don't make all those mistakes before they enter retirement.
What are the most common financial challenges faced by the individuals approaching retirement?
I would say procrastination is probably the worst. I mean, there's so many challenges that we can go over. We could spend all day talking about them, but procrastination is number one. I mean, people put it off and put it off and put it off. And really, really you need to start as early as possible. I mean, I try to drill this into my kids who are teenagers. You got to be thinking about what's going to happen 20, 30, 40, 50 years from now and really have a plan in place. And if you get a plan, a written comprehensive financial plan, and you start putting it to work, it's just like anything else. If you have a blueprint, the building's going to be great if you got a blueprint. But you start trying to construct a building without a blueprint, things going to fall over when you're done. So you got to have a blueprint, and having a financial plan, a blueprint where you know exactly what you need to save, what it's going to look like, what your goals are. Not only does it get you in the right position where you're doing the right investments in the whole bit, but it also gets you in the right mindset. So you're thinking about, oh, I need to do this so I can make this happen. And so procrastination is the one thing you want to avoid. You want to just get on it, start thinking about retirement planning, go see a financial advisor that knows what they're doing, and actually build a plan as soon as you can. Or there is no too early.
And when you say plan, I think most of us, we already say put 10 to 15% to a 401k or including Roth. And
Sure.
to me, that sounds planning to me. And what the additional planning do you think that we would say?
It really depends on your individual situation. I mean, if you're saving 10 to 15% and you don't have a 401k and you're just going to rely on, your savings and Social Security, that's a challenge. Obviously, you want to put money if you can in a 401k with your employer. They oftentimes have a company match under safe harbor rules. It's very common to see a nice match that goes in there. So make sure you're doing that. But in addition to that, you have to also take into consideration your individual circumstance, and time is your biggest factor. In the event that you start early, I mean, if you're in your 20s and you start saving 10 to 15%, you're probably going to be fine by the time you retire, because with compound interest, you're going to grow to a good chunk of money and it'll be a good offset. But if you're starting later in life, if you're starting your 40s or even later, you're going to have to save a lot more than 10 or 15% because you need to build that account up. And when you don't have the time of compound interest to help you, every situation is different. So you really have to look at your individual situation. And if you don't like the numbers, you say, hey, I want to retire at 65, but you don't like those numbers. Well, then you have to work a little longer. You got to save a little more. So one of the two has to happen.
If I am clients and I come to you, and here is an example. Say I'm 40 years old and currently say I have only 100K in my retirement accounts. What kind of advice would you provide to me?
Well, it really depends on what your time horizon is. If you're 40 years old and you're going to work until you're 65 and you have good income, obviously you can save and build that up using retirement accounts. You might consider real estate. Real estate's a good option because you can leverage real estate. You can put down a down payment and buy a much bigger value house. Now, obviously you want to buy it at the right time. I'm not suggesting today is the right time with really high home values. And now that interest rates have spiked up, we have a real frozen market. So real estate may not be the best solution now. But if we get an opportunity, if real estate prices come down and interest rates maybe come down at the same time, you may have an opportunity to leverage that investment where, if you put 20% down on an investment and that investment goes up 50%, well, you actually get a much bigger return on the actual 20% you put down because you're essentially controlling $100,000 worth of money with $20,000 if you put 20% down. So in that case, you might consider that as an option. I like all kinds of investments. Stock market's great. Obviously, it's provided great returns over time. It's liquid, but real estate's great. I also like right now, I think natural resources are a great spot to be. Oil and gas, I think there's an underinvestment in that. And I think there's going to be a big demand for energy needs, especially with all the new technologies that are coming out. I'm not sure if it's accurate, but I read somewhere that it's like 15 times more energy to do a Gemini search than a regular Google search. And when you start thinking about the energy needs that we're going to need, we can talk about how we want everything to be solar and wind and renewable. But, at the end of the day, we're going to need energy, and oil and gas is typically the least, the least environmentally unfriendly and also the least expensive. And so obviously I don't suggest we go out and burn coal, which is probably the cheapest way to get energy because of the pollution, but we have to find a happy medium. And I think there's a lot of opportunity in the energy space.
And with all these investment opportunities that you have in your portfolio, how do you choose which one that you would suggest to your clients?
It's really about value. So it's real important that people separate price from actual value. And so when you start looking at the markets in any investment, you want to look at the real long-term value of that investment. And, there's famous people like Warren Buffett that talk about how to do this. And there's a lot of different, books and things you can research research and read on this. But price doesn't mean a whole lot. People talk about, oh, the Bitcoin price went way up, but Bitcoin doesn't have any value, right? It only has value if someone else is willing to pay you the same or more than what you paid. And so you really want to look for investments that have real value, that produce real income. And over time, those typically perform well. And when you're comparing the stock market, there's a real disconnect between what are called growth and value stocks. Growth stocks are companies that we expect to have a much higher profit in the future. A lot of these are the big technology companies. And then there are value stocks. These are companies like Coca-Cola and McDonald's and Home Depot that have, good dividends, but they don't have a lot of growth prospects. Well, what you do is you compare these two types of investments, and in times where the interest rates are real low, growth stocks do very, very well. So obviously when interest rates were really low in 2018, 19, 20, 21, growth stocks did fantastic. But in times where interest rates are really high, value stocks typically outperform growth stocks. And we're looking at interest rates now near 5% on the 10-year Treasury, and a lot of the long maturities are up there. So when you look at these higher interest rates, value stocks should outperform. And that statistically, you can go back, 40 years and see the numbers, and it's pretty clear.
Okay. If your clients give you their IRA accounts to manage their money, do you add them into self-directed IRA and then help them to diversify their
Well, we actually use an institutional platform. Charles Schwab is who we currently use as the custodian. So we actually manage people's assets, under management. But there's also things that you can't do under a normal platform. And a lot of this applies to accredited investors and people that have maybe some additional assets. But there's areas that we can get into in real estate, in royalties, in oil and gas investments, things like that are kind of outside the normal parameters. And a lot of those types of investments do require a self-directed IRA, where we kind of help them set it up, and we're an interested third party that helps them put it all together, and it's part of their financial plan. But most of the time, we just have IRAs with Schwab that we manage, and we also do some insured stuff too. A lot of people come to us and say, "Hey, I don't want to lose any money. I want guaranteed income. I want to see a pension payment coming in." Well, we would use like an insured product, like an annuity for that. Obviously, annuities did not perform very well when interest rates were low, but now that we've got these big interest rates, you can get into some of these annuity contracts, these MYGAs, multi-year guarantee annuities, and we're getting well over 5% guaranteed interest, can't lose. There's no M&E charges, no sub-account fees, real simple. So there's an opportunity now to make some decent interest. And so when you think about investments like stocks and real estate and oil and gas, those carry risk, right? You have to put your money in, and there's a chance you can lose money if things don't go right. You can also make a lot of money, but with the annuities, it's insured, right? So it's 5%. So you really need to thinking about making 7, 8, 9, 10% on the investments that carry risk, because you can get 5% with no risk at this point, right? So those obviously are a good spot to be in the current market environment, because if you can get 5% with no risk, well, yeah, take advantage of that.
So the capital must be locked in there for a certain number of years.
Yeah,
right?
most of the ones, if you have a good contract, you're looking at probably at least 2 to 3 years minimum. Some of the better ones might be 5 years. It just depends on the different MYGAs that are out there. You can look at the different rates. It's interesting. Right now, we have what's called an inverted yield curve, and a lot of the shorter duration actually pays a higher interest than the longer duration. But I even in this market with what's going on, I don't know if it makes a whole lot of sense to go longer duration, because the thought is, okay, if interest rates go up in the future, you're stuck with this lower rate, right? And so you have to wait until it matures to get into the new rates. And if interest rates go down, oh, well, I got this rate for longer. But I know that the Fed says they're going to lower rates in 2024. And I know that that's kind of the narrative on Wall Street. I don't know how they're going to do that with the current inflation numbers. So I think we're going to see interest rates higher for a lot longer than a lot of the analysts predict. And so it might be a good idea to take advantage of the highest rates you can get now, maybe on a 3-year, and see where everything's at 3 years from now, because I'm not sure rates are going to be down much from where they're at now. Historically, we're at pretty low to average rates. They're a lot higher than they were when we had rock bottom, 0% rates. But at this point, just take advantage of the 5% rates you can get. 3 years, 5 years makes a lot of sense.
What's the difference between annuity and CDs?
Well, they're very similar. The annuities, there's a lot of different types of annuities. So when you say annuity, are we talking about a variable annuity? Are we talking about a fixed annuity? Are we talking about a fixed index annuity? Are we talking about immediate annuities? There's all kinds of different types of annuities. But, when you're comparing comparing what's called a MYGA, MYGA, that is basically like a CD with an insurance company. And so it's very similar. You get a fixed interest rate. It's almost identical. I kind of like the MYGAs a lot better than CDs right now for several reasons. One is the banks don't really have the reserves. I mean, if you look at what they're doing, in my opinion, is fraudulent. They're doing what's called mark to maturity. So when you have loans on your books, say it's a 30-year fixed or, whatever the loan that you own, they're marking the value of that loan to the maturity date when the final payment is made. If that bank had to sell that loan early because depositors were requesting their money, they're going to take a huge loss. I mean, if they're saying that the loan is worth $1 million, it might only be worth $700,000 or $800,000 if they had to sell it right now, because the interest rates are a lot higher now than they were, and that current loan has a much lower rate. So no one's going to pay the full price for it. So the banks, in my opinion, are a little bit shaky. And I know we have FDIC insurance, and as long as everyone's under the 250,000, the government's going to, bail everyone out. But when you look at the reserve ratios, the FDIC, it doesn't look very healthy. And so I kind of like the reserve ratios at the insurance companies a lot better.
What's the typical return that you have for your clients? Say your clients invest your money in real estate compared to, say, oil and gas, or compared to stock market?
They're all very similar. It just depends on the timing. I mean, oftentimes real estate investments, I mean, if you go back and look at history and say, okay, what's the highest return? Well, depending on when you choose, right? If you say, oh, I'm going to start at this date and then go to this date, you can pick and choose and come up with any statistics and numbers that you want. But historically, stocks outperform real estate historically as far as total overall returns annually. But the difference is that real estate, you can leverage it. So you don't necessarily have to put the whole full amount down. And if real estate prices go up in the future, you've got a leveraged investment. So if you have time on your side and you're buying real estate at the right time when the price is low, real estate can oftentimes be a better investment just because of the ability to leverage. Now, of course, the other big advantage of real estate, and this goes with oil and gas and natural resource investment as well, is there may be some tax benefits that you can get. So with real estate, you can use what's called depreciation. You can depreciate the cost basis of the real estate against the income you receive. And there's all kinds of special provisions. There's bonus depreciation, accelerated depreciation. There's all kinds of investments that use a cost segregation analysis that give you a big deduction up front. So, real estate has a lot of tax advantages, which is really nice. Oil and gas, same thing. You can do royalties. They don't call it depreciation. They call it depletion. Well, I don't care whether you call it depreciation or depletion. I just like tax-free money. And when you start looking at retirement income and planning, this is probably the biggest expense that people have, and they don't even think about it. If you Google, what are my biggest expenses in retirement, they're going to say, oh, housing and food and medical expenses. But no, none of those are accurate. The real biggest expense is taxes. So you really have to look at taxes. You have to think about what taxes you're going to pay, and not just the direct taxes that you pay, on your income, but also the indirect taxes. And the big one's inflation. Prices of gasoline and groceries and airline tickets, they're all going to be more expensive in the future. And the reason this happens is the government runs deficits. They have to print the money out of thin air, and they get, bigger debt. And then what ends up happening is that money goes into circulation and prices go up on everything. And usually it hits people, especially people on fixed incomes, people that are in the poor and middle class. It hits them the most because the largest percentage of their income is for food and housing and these kind of things. And so, inflation is a big tax, and you got to be paying attention to it.
Now, how can people mitigate from that then?
Well, the secret is to invest in investments that do well in an inflationary environment. And these are the same investments that typically do well in a recessionary environment, which I think that we're getting ready to enter. If we're not in one already, we're seeing a lot of stagflation. A lot of the economic data is coming in really, really poor. You're seeing P-print is down, obviously. We're seeing the Chicago PMI just came out last week, and that was a disaster. I mean, it was like 37.9. I mean, talk about a contraction. I don't think I've ever seen a number that low in my career, except maybe during COVID or at the bottom of 2008. I mean, that's a rough number. And even the services, the ISM services index, I mean, that went negative. I mean, it's at 49. Anything under 50 is contraction. So that just went into contraction. Employment numbers came in really bad. You're seeing the Dallas manufacturing is way under. So when you start looking at these data, I mean, it doesn't look good as far as the economy. So when you think, okay, where do I need to invest in a recession? Where do I need to invest in an inflationary environment? Because the government's going to come in with all kinds of stimulus to save us from the recession that's coming. And it's real simple. This is what I tell people, and this is real important. People need to eat. They need to put gas in their car, but they don't need to upgrade to the iPhone 15. So you just have to really think about your investments and where they're at, and you need to be invested in things that do well in an inflationary environment. Of course, a big one for that is precious metals is a popular thing. If inflation really gets out of control and there's really a currency crisis, you want to be in gold. But also, people need to eat. They need to put gas in their car. So you want to focus on things that people need, necessities. Buy stocks that do well with economic ties to things that people need, not things that people want.
I love this. And how can retirees minimize their tax burden on retirement income?
So it really depends on what their tax burden is. So if their income is not that high, they're not going to have a big tax burden. A lot of people think I'm going to pay all these taxes. Well, if you're getting Social Security, part of it's federally tax-free anyway, no matter what your other income is. It's all state of California tax-free. Most states don't tax Social Security, so that's all tax-free. So that's usually a big chunk of people's retirement. If you're getting other income, you may have taxes to pay on IRA distributions or pensions and things like that. But one big one that I think is a great thing for people to do before they retire is probably the best thing you can do is a Roth IRA conversion. This is where you move money from 401ks and IRAs and 403bs and TSVs. You convert them to a Roth IRA. And at the time you convert, you have to pay tax on the amount you convert. But if you're in a situation where maybe you retire, you're not collecting income from wages, from a salary, and you're also not drawing your Social Security yet, you're going to be in a real low tax bracket. So let's convert IRA money to Roth right now. And are there any tax offsets? And sure, there's lots of offsets you can do. So if you do a big Roth conversion 1 year, we might, first of all, go into an investment that has some kind of a valuation discount. There's a lot of real estate investments that have that. We might have tax offsets like a charitable land donation. Maybe we'll do some oil and gas investments that have 100% bonus depreciation, accelerated depreciation in year one. So you can convert a lot of money all at once. Now, a lot of these types of investments are only available to accredited investors. And these are people that have $1 million in investments outside of their primary residence. And these are just SEC rules that say, hey, we want to make sure that you're sophisticated enough to do this. Well, generally people that are in the higher tax brackets that are going to benefit from a lot of this tax deduction are the people that are accredited investors. So it kind of works. But the only other way to bypass that accredited investor rule currently is to have a financial advisor license. And that's an option. Go out and study and take the test.
And so do you actually recommend that people do 401 to Roth IRA conversion or like early on or closing to their retirement age?
Yeah, no, I mean, anytime. I mean, people don't really understand. The best analogy I can give you for an IRA versus a Roth, and this is really important, and I don't think people really get the long-term benefit of the Roth IRA. It's so much superior to a traditional 401k. I will say that early on, obviously, the Roth is way more valuable because you got a lot more time for it to grow tax-free. Someone who's got maybe a really high income and they're getting ready to retire, okay, maybe it's better to go pre-tax and take the tax deduction in the last few years while your income's high and you can, high tax bracket, fine. But for most of your career, Roth IRA is better. So the best analogy I can give you is I like to think of if you have a rental house. Let's say you live in your house and next door is your rental house and you're renting that out. And let's say that rental house is worth $1 million and you have, say, a $400,000 mortgage on that house. Well, if you were to sell that house, you wouldn't get $1 million, right? Assuming there's no capital gains tax, you'd get $600,000 because you have a $400,000 mortgage to the bank, right? Well, if you cash in your $1 million 401k right now that's pre-tax, are you going to get $1 million? And the answer is no. You're going to get about $600,000 because there's a $400,000 mortgage on that 401k, and that mortgage is to the IRS, right? But here's the worst part that people don't think about. I want you to think about that analogy with a rental house. Let's say that rental house doubles in value. Let's say it goes from $1 million to $2 million over the next 10 years. It doubles in value. Inflation goes up to $2 million. Does your $400,000 mortgage that you owe on that rental house, does it double to $800,000? Well, no, that would be a horrible mortgage. I mean, who would take out a mortgage that when the house doubles, the bank gets to double what you owe? I mean, that's a horrible mortgage, right? Well, that's what you got on your 401k. I mean, if you have $1 million 401k and it goes to $2 million, the $400,000 IRS mortgage goes to $800,000, right? It doubles. So as your account goes up, more and more money goes to the IRS. So my suggestion is to pay off your rental house, pay off your 401k. We want it to be tax-free. So when it goes from $1 million to $2 million, it's all tax-free. And so the Roth IRA is far superior in most cases. Now, obviously, every situation is different. So people need to go out and talk to their financial advisor. Obviously, they can call us. We've got advisors here on staff that can help people, but at least go back to their current advisor and say, hey, I heard this on this podcast and I want to know if this makes sense. Should I be doing a Roth IRA? Should I be doing a conversion? And if your financial advisor doesn't know much about Roth IRA conversions or understand this stuff, get a new financial advisor because it's important stuff.
And you convert all the money that you have in your IRA or 401k into Roth IRA?
Absolutely. Yeah. In fact, there's cases moved to $500,000 in just a few years with little to no tax impact, depending on the client, what other assets they have, if we can create offsets, if we can do valuation discounts, can you do it? Yeah. I mean, you should put all your money in a Roth because ultimately it's important when you start thinking about all the income you have. Let's say you're a married couple, you got 60 grand in income coming from Social Security, you got 60 grand coming from your Roth IRAs, you got 60 grand coming from depreciated real estate income, you've got 60 grand coming from depleted royalties, you got 240,000 in income, 20 grand a month. How much tax are you going to pay? The answer is zero, right? Because all this is depreciated out. The Roth's tax-free. And if you're only making 60 grand as a married couple and Social Security, and that's the only thing that you're showing on your taxes, well, that's tax-free because they take half the Social Security, they cut it down to 30, and you're under the 32,000 threshold for a married couple to tax Social Security. And the state of California doesn't tax Social Security. So, I mean, you're basically tax-free at 20 grand a month. And people, how can I do that? Well, you got to convert it all to a Roth. Now, people that have big pensions, obviously they're not going to be able to do this because the pensions are going to be taxable. People that, have other income coming in, may not be able to do this, but at least you can do part of it. I mean, figure out how to cut your taxes at least. If you can save money in your taxes, I like to think of it, it's more valuable than earning $1, right? You think about, I'm going to make an extra $1 on my investment by being more aggressive and putting it in better investments or whatever the case is. I made an extra $1. Well, you didn't really make an extra $1. You made an extra 60 cents because you got to pay tax on that money. But if you save $1 on your taxes, you get to really collect $1, right? If you take $1 off your taxes, that's $1 you get to keep. So $1 tax saving is more valuable than an extra $1 in investment returns.
I love this. Thank you. Since you work with retirees, I wonder if you met a lot of clients who are also in the stage of, say, transitioning to senior livings.
Yeah, so there's two stages, right? There's independent senior living, which is typically private pay. These are great places people want to go because they want to be close. A lot of times it's widows or widowers, they want to be around other people. They don't want to be alone. And so these are great communities. There's a big demand for these communities. There's not enough of them being built. We actually work with a company that is building these properties all over the country. And it's a great investment for people to put money in to the investment. And so you get a lot of good returns and benefits from investing in these. Now, that's the first way. That's like kind of the independent living. So a lot of those are senior living with memory care and things like that. Then there's what's called skilled nursing. These are like nursing homes when people get to the point where they need round-the-clock care. This is like Alzheimer's, stroke, things where they're really struggling. And that's where you want to really be in a position where if you don't have enough money to pay for that, and it's expensive. I mean, some of these here in San Diego are 8, 9, 10, 12,000 a month. And so you want to have Medi-Cal here in California. The rest of the country is Medicaid, but I think Massachusetts might be a different name, but here in California, we call it Medi-Cal. And you want to do your best to position the rest of your assets where they can't come in and seize a bunch of that from the estate. And so there's some exempt assets like your primary residence, your retirement accounts, all your IRAs, your Roth IRAs, they can't touch those. They can't claw back the money. They're actually a lot better now than they were in the past. They put some provisions in place that let a stay-at-home spouse keep a certain amount of assets. And there's some interesting little loopholes. I'll give you an example of one. You can have one vehicle. Well, they didn't put any value on it. So, if someone gets to the point where, they're 100 grand over qualifying for something, well, okay, well, your one vehicle is now going to be a classic Corvette that's worth 100 grand. The value is probably never going to go down. It's going to just go up, but that's your vehicle. So that's an exempt asset, right? So you just think about how to be smart about qualifying for some of those programs. And then, of course, if you get into a position where you've got enough assets and enough income coming in and everything's great, maybe you don't even need that. You can hire someone to come take care of you in the comfort of your home. And that's great. And hopefully we can get someone built up to the point where they can do that. But if they haven't saved enough and they can't do that, how do we protect the family house? How do we protect it from, the state of California or someone coming in and seizing those assets? How do we make sure the kids get that property? And again, there's a lot of provisions that have been put in place recently that have helped protect people, which is great. It's not as bad as it used to be, but you still want to do planning around that.
So since you mentioned that you are working with a developer who are building this senior living communities, how does investing in senior living compare to other asset classes, more like real estate asset classes, say multifamilies and housing, hotels, or storage unit, or even mobile home park and RV?
Real similar. I mean, it's a risk profile. So I'll give you an example, like apartment buildings, you get pretty safe. Senior living's considered safe, maybe not quite as safe as an apartment building or a storage unit, but it's considered a safe investment, pretty recession proof. And I think history's shown that even during COVID, which, should have been, this is the industry that gets hurt, right? All these people affected by COVID, and it actually performed really well during that environment. So it's a good investment, safe. Now, when you start going out on the risk spectrum, when you start looking at like hotels, for example, obviously those are impacted by fluctuations in the economy. So, if you have a bunch of empty hotel rooms, you're not going to make money. But of course, your potential returns are a lot higher, right? So it's all about risk profile. They're all similar. You just have to see, okay, well, here's my return, here's the risk. So this is a little better return, a little higher risk. Well, there's a really good potential return, but there's obviously a lot more risk. And when you go into things like, oil and gas, for example, obviously dependent on oil and gas prices. So we might have an investment that says, okay, well, you're going to make 10 to 12% returns if oil's at $75 a barrel. Okay, that's great. But what if oil's at 60? Well, then those returns are coming way down and may go away. But what if oil goes to 100 or 120? Well, now we're going to make even more money. So obviously there's more potential gain there, but there's also more risk. And then you just have to think about how to mitigate that risk, right? How you have to think about it. Like for oil and gas, for example, I'm looking at those returns and I'm saying, okay, this particular project's underwritten for 10 to 12% returns at $75 barrel in oil. What's the chance of it going down? Well, you start Googling, you start researching, you say, wait a minute, the Biden administration says they're going to start buying oil as soon as it goes below 72, refill the strategic petroleum reserve. So we have this massive buyer who's going to come in under 72. Well, that helps put a floor on the price of oil. If it starts going down to those levels, we're going to have a massive buyer. So then I get a little bit more comfortable about this investment and say, well, gee, the chance of this thing going down is probably a lot lower because you got this massive buyer that wants to refill the strategic petroleum reserve. And what's the potential for it going up? Well, what if we need all this extra energy because all these data centers and all this new artificial intelligence and everything they're doing is requiring much more energy? Well, maybe the price of oil goes up, maybe it's 100, 120 a barrel. Well, then I'm going to make a high return. So then you just got to compare what's the risk versus the reward and just look at each client has a different risk profile and just determine what's appropriate for that particular client and what they're comfortable with.
Love it. So how is multifamily? Do you think multifamily is still a good investment right now?
Absolutely. I think multifamily is a good investment. You got to be careful with some of these projects that are carrying older debt, older loans, because they may be resetting at a higher rate. So if they took out the loan at 3-4%, and it's going to reset at 7 or 8 or 9%, that's a problem for those projects. But if you're getting into a new investment where you're actually looking at current rates and it's already priced in with a 7.5% loan, great. Or even better, maybe it's a debt-free project, right? It's all cash, all equity, no debt. It's a debt-free project. Well, then you don't have that kind of risk. But no, I mean, there's a huge demand for housing. In fact, if you look at housing and the amount of rental units that were built, I mean, you're looking at 20 million per year. I mean, just crazy amount of numbers. And all of a sudden, between 2009 and today, the amount that are being built is a fraction. I mean, it's a joke. It's like 25% of the rental units being constructed that had previously been constructed. And so, yeah, there's a huge shortage. And I just see rent prices going up. And there's a big shift in demographics and population. Obviously, people are getting older and population is moving, right? And so California and Illinois and New York are losing people. And other states like Arizona and Texas and Florida, they're gaining people. And so you want to focus on the area that people are moving, where there's plentiful jobs, and then also focus on the actual number of units being built. So you look at an area like Austin, Texas, for example, a lot of people are moving there, great, but they're also building a lot, right? So they're building a lot of supply to accommodate all those people moving in. So you're not going to see a big rent growth. Where you look in another area of the country, for example, like San Jose, right? California, boy, everyone's moving out of California. But San Jose is this AI kind of different spot. It's this capital of this AI boom. And they're creating like 5 or 6 jobs for every one new apartment being built. Well, that means rents are probably going to go up more, even though people are leaving California. Rents are going to go up more in San Jose because they're just not building. Obviously, with all the red tape and regulations that California puts on builders, they're not building as many units. Plus, there's just not as much land available to build, and that land is expensive compared to, maybe Arizona or Texas or other places.
San Diego is still a pretty solid market here.
San Diego is obviously a special place. I think there's going to be a demand for San Diego. I think the prices of real estate will continue to be elevated here. And there's also not a lot of room for expansion, right? You got the ocean on one side, you got Mexico on the other side, and then you got the mountains and desert to the east, and then you have LA to the north, which is already all built out and overcrowded. So there's not a whole lot of room for expansion. So I think that San Diego is kind of a special market. But if we start to have a real recession, a real downturn, and I'm not predicting this, I think especially in an election year, I think the Fed's going to do everything they can to keep the markets up for November. But all bets are off after the election. And if we go into a deeper recession, obviously home prices are going to be impacted everywhere, not just in areas where they're overbuilding, but in areas like San Diego too. So if an opportunity presents itself and you see prices come down and we're in a bad recession, you just have to, see if you can take advantage of that. Can you figure out how to buy into that market? Can you buy stocks when they're down? Can you buy real estate when they're down? And it's kind of the opposite. Most people, when the stocks are really cheap, they get scared and they sell at the wrong time. And then when stocks rally back, they go, gee, everyone's making money in the stock market and I'm not in it. And then they put their money in at the end at the wrong time. So you kind of have to do the opposite of what the crowds are doing. And so just look for those opportunities and be contrarian. It's important with investing. It's probably the biggest thing that a financial advisor learns when they start studying investments and finances. You want to do the things that other people are not doing. Keep in mind that if you're in a position where people start losing their jobs and we go into a real recession and people have to sell, real estate's a really low float market. So what I mean by that is if there's 100 homes in a neighborhood, there might only be one or two that are affecting the price. And if someone has to sell at a discount for whatever reason, they lose their job or maybe they inherit the property and they don't care, they just want to sell and get the money. If they take a discount, that comp is going to be what they use for the rest of the neighborhood for comps. And as those prices start to come down, it kind of becomes a cycle. And so it starts to cycle down. And real estate typically it goes up more than you ever thought it would. But when it turns and it starts to go down, it goes down more than you ever thought it would. And because of that low float, you got to be paying attention to that. So I agree, we're kind of an insulated market. But if we go into recession and people start losing their jobs, well, that's going to change. That's going to change things.
So do you think maybe senior living or multifamily is more recession-proof than single-family homes?
It's all based on cash flow. Yeah. I mean, you look at return on investment. I mean, San Diego is kind of a unique area. You look at your ROI when you buy let's say a house in San Diego and you're going to rent it, your return on investment is pretty poor compared to what it costs versus what you're going to rent. But if you look at the cash flow in a place like Texas or Indiana or Tennessee, the cash flow is actually pretty high. Your ROI is a lot higher. So you really want to look at that. I think it's important. And so when you're looking at investment properties, if you're buying properties that have good cash flow and good ROI and the markets come down, well, so what? You're going to still collect good cash flow and good rent. But if you're looking at like a single family home or a condo, especially if it has like a big HOA fee and things like that, I mean, you could really be in for trouble as the prices come down on something like that.
Thank you for the advice. I love it because I was actually in the process of thinking buying another condo. Then they have a big HOA fee.
I would avoid condo for sure. You want to look for an area that does well in any environment. Obviously, near schools is always a good idea because there's always demand for student housing. Look for good education. Parents want to move to the neighborhood that has a good elementary school. So you want to focus on that. But you probably want to wait and see how this shakes out with rates because these interest rates have really spiked up. You can follow interest rates. I use mortgagenewsdaily.com and you can see exactly what people are paying on 30-year fixed rates at any given time. And these rates have come up so much and it's frozen the market. If you look at the number of transactions that are actually happening now, we're back to the mid 90s. I mean, like 1994, 95, this is the number of transactions that are happening. And with the market frozen like this, someone's going to blink. And I think that what ends up happening is the prices have to come down or inflation really has to spike up and maybe housing prices stay the same, which is also a possibility. But no, at this point, it's way more expensive to buy than it is to rent. And you certainly don't want to be a person buying a rental property when it's expensive to buy and it's cheap to rent. You want to wait until it flips and it becomes more expensive to rent and it's cheaper to buy.
Thank you. What factors guide your decision-making process when considering investments in senior living properties?
Well, I mean, really, I like to think of investments. I kind of think of this as red and green money. And this is something that I picked up from an advisor in the Midwest who's really sharp. Red money is money that's in stocks, mutual funds, ETFs, rental properties, things that can go up and down in value. Green money is our guaranteed money. This is our Social Security, our pension, our annuities, things that we know is going to be there. So I like to call our green money our no-so money. We know it's going to be there. And I like to call our red money our hope-so money. We hope it's going to have a higher return than our green money, but it's not guaranteed. So what you do is you focus on the green money first. Can we get a higher return than we're getting now? And if you have money sitting in a bank earning 1 or 2%, we can get 5% right now with no risk. Well, obviously that's an important move. We want to take our Social Security at the right time. There's a big mistake a lot of people make is they leave a lot of money on the table. In fact, I think there was a recent article I read, something like 80% of Americans are taking their Social Security at the wrong time. And I think it said as much as 180,000 over their lifetime is not being paid out for each person because they're filing for Social Security at the wrong time. So you got to do that first. Green money's first. Figure out the highest returns without any more risk. Then look at the red money and ask ourselves, can we get stock market returns without taking maybe as much risk as just buying the S&P 500. And sure, there's a lot of ways to do it. We use structured notes, what we call a buffered index, where we can go into the S&P 500, but it has some protections. We go into it with a cap and with an insurance buffer. So if the market goes down, we actually get reimbursed on a bunch of our losses, or we actually get paid. If it's dual directional, you get paid on the way down. So you can hedge against that risk. It's very important to take a look at that as far as especially going into retirement. And then, are there other factors? Is there tax reduction factors that we can consider when investing in real estate and oil and gas? So it just depends on the individual client. Everything is so customized. Every person's different. We'll have someone that comes in, maybe they got a big pension and they're going to get their Social Security. Well, they can afford to take a lot more risk with their 401ks and their investments because they have a big pension. They have a big Social Security check. Well, another person might come in and they have no pension. They just have their Social Security, but they got $1 million in a 401k. Well, we can't take as much risk with that $1 million because they're going to need that money for income. They don't have a big pension to fall back on. So we might want to reposition a chunk of that money into some guaranteed accounts that are safe. Move that from red to green money. How do we get guaranteed income? What's the highest guaranteed withdrawal rate we can get? And now with some of these annuities with the income riders, I mean, I'm seeing 6 and 7% withdrawal rates guaranteed for life. I mean, take advantage of it while you can. It's kind of like when interest rates are really low, you want to refinance your house for as long as possible, right? At the low rate, which I did. Right? I got like a 2.6 rate. Current rates are 7+, right? Well, when interest rates are high, like they are now, you want to refinance your green money. You want to move your annuities into better annuities. You want to move into guaranteed accounts that provide guaranteed income and take advantage of these high rates while they're available. When the Fed's announced that rates are going to come back down this year, and I know that they don't want to disappoint Wall Street and they may lower rates. But I don't know if that's a good economic decision when in the face of all this inflation we're seeing. And I think inflation is a lot higher than the government's telling us. In fact, there was a recent article I read, I think it was Larry Summers, one of the advisors. I think he was an advisor under Clinton, maybe Bill Clinton administration. Anyway, he mentioned that, the inflation was allegedly 8.7% in 2022. And he said, if you actually calculated inflation based on how we used to calculate inflation, like back in the 80s, it would actually be over 18%. And so that's a big jump. And of course, we all know that. You go shop at the grocery store, you go to Costco, you go to these places, that inflation is a lot higher than they're telling us. But you got to factor that in. It's an important calculation to do. And all inflation is a tax. It's a tax that typically people have to pay at the lower economic income ladders, the poor and the middle class, because a bulk of their money bulk of their spending is in food and shelter and energy and gasoline. And so it's a factor you would definitely want to consider throughout your retirement.
You mentioned that people tend to take the Social Security income at the wrong time. So what's your advice on that?
Well, that's, I used to do this with a piece of paper and a calculator and a pencil, and I calculate the best time for someone to file. Today, I feel a little guilty. I just plug their information into an advanced computer algorithm. It prints me a report that tells me mathematically the best way for this person to file for Social Security. And everyone's different. Anyone who tells you should take it at 62 or 70 has no idea what they're talking about. We're all different. And especially for married couples, I mean, there's so many different factors. You got your own benefit. You got a potential spousal benefit. I mean, people can file based on their spouse's work record. record instead of their own and get a percentage, and doesn't reduce your spouse's benefit at all. You also have to take into account survivor benefit. I mean, if you have two people collecting, a husband and wife, one of them passes away, one of those Social Security checks goes away. So you want to make sure that which check is the one that we want to maximize. So who should be taking their Social Security early and who should delay? And the reason for this is the survivor gets the biggest check. So if you got two people each collecting $1,000, that's $2,000 together. One person dies, the survivor gets $1,000. Well, if that same couple just decided that one person was going to take it early and get $750 and the other person was going to delay and get $1,250, well, that's a 25% increase in the survivor's income because the survivor gets the biggest check. So if you maximize one of those checks, it makes a huge difference. And you start factoring in cost of living adjustment. I mean, it's huge. People don't think about this, but every year the government calculates the cost of living adjustment. So you get a COLA on Social Security every single year. And, it was 8.7% in January of 2023. It's only 3.2 this year, allegedly. That's what the government says it is, but it was 8.7 in 2023. Well, someone who was 67 in January of 2023, and they waited to take their Social Security, they actually got not an 8.7% increase in their payment. They got a 16.7% increase because they got the 8% for delaying plus another 8.7 for inflation. So an extra 16.7 above what they thought they were going to get. And then that compounds on top of itself, compounding every year for the rest of their retirement. So you got to factor that in. One of the biggest mistakes that people make is when they look at their Social Security statement, they go, oh, this is what I'm going to get at 62. This is what I'm going to get at 70. Well, if you're 62 right now and it says this is what you're going to get at 62, that's an accurate number. But if that same paper says this is what you're going to get at 70, that's wildly inaccurate. In fact, if it says you're going to get 3,000 at 70, you're probably going to get over 4,000 at 70. And that's because there's 8 years of cost of living adjustments that are going to happen between 62 and 70. And that piece of paper is calculating today's value. It's not factoring in the future. So if you're doing the math in the future at age 70 on that 3,000, that's a way inaccurate number. It's going to be way better. It's going to be 4,000. So you just got to do the math. And we have obviously a computer where we do this for people free of charge. People call the office, ask for one of our advisors and say, hey, Matt said I could get a free Social Security report. Tell me exactly when to file. And we'll do it for them. Of course, a big factor on Social Security, and we always ask people this, and it's always kind of a funny question is, how long are you going to live, right? Well, I mean, that's a big factor because if you take your Social Security and you die at a young age, you're not going to collect as many checks, right? If you live to be 100, you're going to collect a lot of money. So someone who's going to live a long time should delay and get the biggest check possible because of the increases in the amount and the cost of living adjustments. Someone who's going to pass away at a young age, well, we don't know. Well, that's okay. You can use reasonableness. If you come to the office and say, I'm healthy, my parents live to be 90, both my parents live to be 90, I'm healthy, I take care of myself, and I get exercise, there's a good chance you're going to make it to 92, right? You got the family history, you've got all these factors. Well, if you come into the office and say, hey, I smoke 3 packs of cigarettes a day, I'm 200 pounds overweight, and I like to drive my motorcycle down the freeway between the cars at rush hour, we're probably going to tell you take your Social Security as soon as possible because your life expectancy is a lot less than the average person. So, everyone's different. We just got to do a custom plan. And the Social Security report is a fantastic tool. And I call it the foundation. When I do trainings for other financial advisors, I really talk about this, about how this is the foundation of retirement planning, because you want to get the most money out of the government, period, right? And just because you're going to retire at a certain day does not mean that's when you should take your Social Security. You might want to delay a few years. You might want to figure it out a different way, fill the gap with retirement income. And sometimes people say that's crazy to me. They say, oh, I'm going to take my Social Security because I need the check. Well, could you take that $2,000 out of your 401k money for a couple of years and run that account down? Well, sure, I could, but why would I do that? Well, the 401k is invested. It's not guaranteed to go up. Your Social Security payment is guaranteed to go up if you wait. But the big one is taxes, right? And so you got 2 buckets of money. Your IRA is fully taxable, right? Unless it's a Roth, it's fully taxable. So when you take money out, all you're doing, if you delay taking money out of your IRA, you're just increasing your tax you have to pay, right? And if you take your Social Security early, you're reducing the money you pay less taxes on permanently. You pay less federal, no state tax. Why would you do that? I mean, it make a lot more sense to spend down your 401ks for a couple of years to maximize your Social Security so you get more income where you pay less federal and no state tax, and you get less money from the money you pay the most taxes on. And this, of course, brings up tremendous opportunity, because if you're not collecting Social Security and you're not working, you retired, you're in a real low income tax bracket. Well, guess what we can do? The single best thing you can possibly do before you retire, a Roth IRA conversion, right? So this all ties together. And it's a matter of creating the synergy between the whole financial plan. And this is why I tell people the worst thing you can do is procrastination. You got to sit down with someone, you got to put a plan together and say, this is what I'm doing. And the sooner you can do this, the better, because it does take sometimes a few years to get the Roth converted, to get the IRA converted to a Roth. It takes a few years to get everything in the right spot. And so if you're trying to do this 6 months before you retire, it's a difficult proposition.
I love it. So what book has had the most significant professional impact on you?
What book is that? It's really not a financial, there's all kinds of financial planning advisor book, but I would say the book that probably had the most impact on me was Think and Grow Rich by Napoleon Hill. And it's really not a financial book. It's a book about thinking the right way and believing in yourself and really creating your own future. And so Think and Grow Rich is great. And it leads into my favorite audio series, which is probably the number one thing that I listen to. I actually got this. There was something that I think was an interview that Robert Kiyosaki, who wrote Rich Dad, Poor Dad, which is another great book. They asked him, what inspired him. And he mentioned this. It's called Lead the Field by Earl Nightingale. And it's an audio series. And so I said, well, hey, if Robert Kiyosaki said this is what he liked, so I got a hold of this thing and I listened to it. I've been listening to it for years. Every couple of years, if things aren't going so great with the business or I'm not getting the results I want, I'll listen to Lead the Field all over again. It's just great. It talks about, having the right attitude, having integrity in everything that you do, and just taking out a blank piece of paper every once in a while and asking yourself, how can I serve my customer better? And start writing ideas down. Some of those are going to be good ideas, some are going to be bad, but all the things that he teaches you in that, I think, are really powerful. And it's not just for investments and financial planning. It's just for everyone, for life, for having the right relationships with our spouse and our children and relationships with our coworkers, So those, I think, are the most important books.
Thank you. And what daily habits has contributed the most to your success?
Daily habits? Well, as a kid, I was diagnosed with ADD, attention deficit disorder, and they wanted to put me on drugs and everything. My mom said no. And I was one of those kids that kind of got into a little mischief and had challenges because of it. But, I think a lot of that, what I've done is I've had to focus my time. And so having an attention deficit disorder makes you kind of want to start projects and not finish them. You kind of go on to the next thing. And I find myself doing this a lot. And so the one thing that really helps me is to really focus on what I have to do. And this is actually one of the things in Lead the Field. He talks about writing down the most important things you have to do that day and then listing them in the order of importance and doing number one until it's don't go to number two, finish number one, then go to number two, then go to number three. So I'm constantly making myself lists, and it's not just daily. I do this sometimes. I do it oftentimes on a Friday for my weekend personally, right? Here's all the things I got to get done for the weekend, right? I got to call the person out to fix the fountain that doesn't work. And I got to take my vehicle in because the turn signal's out, and I got to go to Costco, and so I'll kind of put the important things I got to do on a list and number them, and then, okay, do number one until it's done, and then do number two. So it's having time management, I think, is been really important for me.
Thank you. And how can our listeners to connect with you?
Well, financial planner, sandiego.com. That you can actually abbreviate San Diego. It's at financialplanner.com. That's where you can kind of start. You can reach out to us there. We actually have a system where if you email in, it goes to one of the advisors. We reach back out to you. But that's really, I think, the start with what we're doing. We do have some market update videos and things that get sent out to clients.
Okay, sounds good. Thank you. Thank you, Matt. I really appreciate your time today with me and sharing with us all your knowledge and your expertise. Thank you.
Oh, it's great being here. So thank you so much.